Excellencies, distinguished guests, ladies and gentlemen. On behalf of the Norwegian-African Business Association, NABA, and our partners, the Confederation of Norwegian Enterprise, Africa Finance Corporation, Standard Chartered Bank, DLI Piper, and Norfund, it is a great pleasure to see you all and welcome you this morning. We have an incredible lineup of speakers here with us today that will look into the key trends and issues that will shape the business policy, economy, and business landscape in Africa. In addition to the outlook for the next 2 hours, I hope that you will use this opportunity to connect with the NABA community during lunch. I wish you all an insightful and productive day. And now, it's a great honor to give the floor to the CEO of Finance Norway. Ida Kreutzer has a tremendous background from finance and banking industry. And please, Ida, the floor is yours.
A couple of years ago, as the then chairman of the Norwegian Refugee Council, I had a meeting with the finance minister of South Sudan, discussing the refugee situation and the dire humanitarian situation in the country. After the meeting, he said, "Mr. Kreutzer, you are working in finance. We have fertile soil, access to water, we have natural resources, we need financing. Can we set up another meeting too?" Africa as a continent represents 2.9% of global GDP, 18% of global population. Given the fundamental forces of economy, the potential for significant economic growth over the next decade is definitely present. To improve people's lives, on average, economic growth must be higher than population growth. Population growth has come down over the last 10 years and over the last 5 years, but still many countries have fertility rates of 5, some of 7. We find some of the fastest growing economies on the planet in Africa, but growth has come down. Africa needs to develop millions of new jobs, needs to fight climate change, and needs effectively to adapt to the consequences of climate change, and this requires finance. The supply chain disruption provoked by the post-pandemic surge in demand and the war in Ukraine has pushed up inflation globally in general terms, but more specifically when it comes to energy and food prices. The response to this from central banks and not least the Federal Reserve of the United States have been significantly to increase interest rates to fight inflations. Higher interest rates and a stronger dollar has a very strong effect on the access to and the price on funding in emerging economies. The Financial Times, citing data from the Institute of International Finance, recently reported that foreign investors have pulled funds out of emerging markets for 5 straight months in the longest streak of withdrawal on record. And this is crucial investment capital that is flying out of emerging markets towards safety. This is a part of the backdrop that we are facing when we are meeting here today to discuss effective measures and how to work together to make this situation stronger, better, and forward-looking. And in this situation, one of the most effective things we can do short term might be to share our strong, from a Norwegian point of view, might be to share our strong rating through tailor-made guarantees and innovative blended finance solutions. These are measures that has been developed many places and could be particularly effective in a situation like the one we are facing right now. For the longer term, solutions in education and energy supply, we need to build effective, strong partnerships cross sectors in the private sector and between the private sector and the public sector to effectively develop strong solutions and set the conditions for innovation and sustainable growth. And that is the agenda for today's meeting. That is the agenda for what we are discussing today. And all of this will be discussed, and I'm very much looking forward to a good discussion. And to end this short intro, I will just quote the former governor of the Bank of England: the more we invest with foresight, the less we regret in hindsight. I'm looking forward to hear all the good interventions, and have an excellent day. Thank you.
Can you hear me okay? Yeah? Okay, great. Very good morning, Ida. Thank you so much, Matilda. Thanks so much for kicking us off. Welcome to everybody to the Africa Outlook, asking the question that is on everybody's mind at this time of year: what's going to happen, right? And specifically, what's going to happen in Africa that we should be paying attention to, and why should we be paying attention to it? My name's Lanre Akinola. I'm going to be sort of moderating proceedings up here. I'm also going to be doing the first presentation. This session will transpire in two parts. Part one, a series of presentations. I'm going to start with me, then we're going to hear from Standard Chartered, we're going to hear from Norfund, we're going to hear from Helios Investment Partners and the Africa Finance Corporation. So a fairly heavyweight lineup of people who are going to give us their take on some of the key issues to look out for. Without further ado, I will start proceedings. And before I... Okay, we've got the first slide up there. Just a couple of disclaimers before I start. The first is that what I'm about to say is not necessarily representative of the perspectives of NABA. And just to put my colleagues at ease, that doesn't mean I'm about to say something controversial or scary. I'm certainly not intending to do anything like that. But just in case you do want to quote anything, it's not NABA telling you this, it's me who also works with NABA. Okay, so what I'm going to do is a bit of a sort of quite broad sweep of some of the most important things to keep an eye on over the next 12 months. And then what I'll do is allow the experts to fill it in with all the data, the analysis, and the true insight. So I'll set it up, and then they'll knock it out of the park. Okay. First and foremost, it always makes sense in situations like this, start with the big picture. The big picture is, of course, macro. And the general consensus, although depending on what day of the week you're looking at the news, you get a different take on this, is that 2023 is not going to be an easy year in terms of macroeconomics. There is persistent talk about recession, global recession potentially, certainly a slowdown in many economies, potentially a recession in the US, potentially a recession in the Eurozone, most likely a recession in the UK, etc., etc., etc. Long story short, the outlook isn't great, and we know why. We had the shocks of last year, we had inflation, we obviously had Russia's invasion of Ukraine, we have the supply chain issues that continue to be a problem, and of course we have the ongoing effect of COVID, right? Which seems like it's a long time ago given what a crazy 12 months it's been. All of that is going to some extent carry over into this year. Here are just some headline figures to give you a sense. 3.6 and 3.9, the first two. Those are 2023 and 2024 growth rates that the World Bank is projecting for sub-Saharan Africa. And 4% is the average that the AFDB is projecting for the region over the same 2 years. The IMF just a couple of days ago put its figures out. I think they're at 3.8 and 3.9 respectively for 2023, 2024. So there's some growth. At least there's no contraction, which we saw in 2021. Sorry, in 2020. But it's below the bounce back that we saw in 2021. And given the impact of the last couple of years, it's nothing to get too excited about, but it could be much worse. It's noteworthy that there's some discrepancies between different economies on the continent. Resource-rich economies are slightly differently affected from non-resource or commodity exporting dependent economies, but the overall picture is tough year. Okay, lots of downside risk globally. If the global economy tips into a recession, we could be in big trouble. There is one potential really big upside though. Does anybody know where that is? All right, yeah, well done. Some eagle eyes on there. I like this picture. It is Shanghai. I like this picture because if you've never been to Shanghai and you saw that, you might be forgiven for mistaking it for a place like New York City. Why have I got a picture of Shanghai up there? Well, I would say the biggest story in the world economy this year is China's reopening after COVID. We are obviously focusing on Africa here, but you cannot, I don't think you can have any kind of meaningful discussion about what's going to be happening globally and by extension Africa if you aren't factoring in the potential impact of China's reopening. It is the event of the year. Imagine having gone the last 3 years without the United States effectively being part of the global economy, and then suddenly it opens up again. Huge implications, right? And I would say overall, potentially some really good upside, right? The Chinese economy could grow by up to 5% this year, could ease supply chain bottlenecks, it could boost growth, it could boost demand for commodities. All of that potentially is good news for African economies. So it's not all bad news. There's also some muted optimism about inflation maybe peaking. I think that's premature. But there's some talk that, you know what, like it might not be all doom and gloom. So just a few words on some of the key issues to look at. Investment, always relevant, always important. We don't have full figures for 2022 just yet. So this is from the World Investment Report. It's put up by UNCTAD every year. They put out a trends monitor in January. This is the most up-to-date data. Unsurprisingly, what it shows is that there was an overall reduction in FDI last year. So Greenfield and M&A both contracted. M&A by 6% and project finance by 30%, signaling that overall what we should expect when the figures are updated later in the year, that we likely saw a decrease in investment in Africa. At this point, we just don't have the data, but it stands to reason that it would be in line with that. Significantly, there is a lot of downside risk UNCTAD warns on FDI this year. So we'll see how things evolve, but in keeping with the overall sense of it's not looking that great, the FDI outlook is, I think, subdued. Inflation, I'll leave it to the experts to break down the numbers on this. We know it's a problem. That's the average figure that we're going to see across sub-Saharan Africa this year, according to Fitch. Now that average varies depending on who you speak to. The IMF earlier in 2022 had pegged average inflation around 12% in sub-Saharan Africa, above a global average of around 8%, I think. So it's higher than the global average, and it also masks some of the disproportionate ways in which inflation impacts people in sub-Saharan Africa. For example, 25% of average monthly incomes in most places go to food alone, right? And we've seen some countries, food inflation go up by 30, 40+%. Main inflation in places like Ghana is at 50%. In Nigeria, it's, I think, plus 20%. In Ethiopia, it's in the 30s. So this average, it masks a lot of up and down. And in like Tanzania, it's as low as 5%. South Africa, below 8%. Point is, it's going to come down a little bit, but not by much. That's according to Fitch. It'll be well above the 2010 to I think, 2012 or 2010 to 2021 average, which was around 10.9% for sub-Saharan Africa. So still well above what we saw pre-COVID, pre-2022. And of course, trying to tame inflation is going to continue to be a priority, not just on the continent, but off the continent. I think it was just yesterday the Fed put up rates by another 25 basis points. They're warning of more to come. There's constant speculation about how high will they go, how aggressive will they go. The point is that the inflation issue isn't done. And central banks obviously are still trying to figure out how to get their head around this, if indeed they can. That includes African central banks. We've seen rate hikes in places like Nigeria, Ghana, South Africa. We had one in South Africa just a few days ago, lower than expected. That'll continue to be a theme, obviously. Debt. Now, the reference here, the caricature down there is obviously in reference to the debt ceiling being hit in the US again, and talk about a potential sovereign default in the US. I don't think that's going to happen. But clearly debt is an issue, and debt is a serious issue in sub-Saharan Africa these days. It's been a problem for some time. It's kind of coming to a head. The issue with Africa isn't the absolute levels of debt that economies have taken on, although that's doubled in the last decade. I think the average debt to GDP ratio is around 70%, which by global standards is actually relatively modest. The point is that the service payments are way too expensive, and a lot of countries have been suffering under that. In 2020, I believe it was, we had Zambia defaulting. In late 2022, we saw Ghana effectively default on its sovereign debt because in the end, it couldn't handle the double whammy of a falling currency versus the dollar and sharply rising interest rates by the Federal Reserve, which of course has a direct knock-on effect on your service payments on dollar-denominated debt. A lot of African external debt is dollar-denominated, so these interest rate hikes right now will be hurting in a lot of countries. While Ghana's default was more or less expected when it came, I think it is noteworthy that nobody was really talking about it until it happened. Everyone was it was like the elephant in the room. And I would say that there are probably quite a few African economies and governments out there right now who are in a similarly precarious situation as a place like Ghana is. But they're just not talking about it. Presumably in the hope that things will turn, or more realistically, that we're going to see something resembling meaningful progress on this G20 common framework. So for those of you who might not be familiar with this is the successor to the Debt Service Suspension Initiative, which was launched during COVID to at least take some of the sting out of debt service payments for so-called developing countries. It didn't do a whole lot. And the G20 framework is aimed at being a long-term, more substantive response, not just debt relief, but debt restructuring. Don't hold your breath this year. The two countries to watch are Zambia and Ghana. Zambia is further into the process than Ghana, which has just applied. But only 4 countries have applied so far globally. Zambia, Ghana, Ethiopia, and I believe it's Chad. And none of them have come out with any kind of agreements yet. And I'd be surprised if there is rapid movement this year. But clearly, how Ghana now enters this process of debt restructuring negotiations and how Zambia fares is going to provide some insight into what we might see happening in other parts of the continent if we don't see more sovereign defaults this year. I think it's possible. I don't think it's inevitable. Debt issue is going to be a very pressing one. What else? Energy. Again, no need to provide a huge amount of context. One of the biggest questions right now globally is energy security and the energy future. Depending on who you speak to, you get different sides of that perspective. I think 2 are going to play out in a significant way across Africa this year. One is Europe scrambling. Sorry, that was a potentially risky choice of word there. but scrambling for energy deals in Africa. That's Olaf Scholz on the picture. I don't know if you can make him out. He was in Senegal. I think this was back in October or so. And like many European countries, is now very enthusiastically speaking to hydrocarbon producing economies in Africa to try and, get some agreements in place to get some of that energy over to Europe. The CEO of Eni, that's Italy's oil company, recently spoke about a south-north axis between Europe and Africa for energy security. Interesting choice of word there by him. The point being that you're going to see more of this year. Yeah, there's talk of, we're no longer buying gas from Russia. Great. You haven't even come close to making up for that gap, right? So Africa is going to play some role in that. And to sort of balance the argument, renewables. So we're going to see, obviously, stuff, money going into oil and gas, continue to go into oil and gas, because the reality of energy security is something that parts of the world just need to get their heads around. And like it or not, substantial reserves of this energy are in Africa, and they are going to be developed and produced. The other side is due to the energy crisis triggered by the invasion of Ukraine. According to the International Energy Agency, this is lending unprecedented momentum to the push to get out of fossil fuels, out of dirty energy, and get into renewable energy. This is an IEA estimate that over the next 5 years, by 2027, the world could add 2,400 gigawatts of renewable capacity alone. That is the total equivalent of China's combined generating capacity today, just in renewables, to be added globally. Right? I think that's like 30% higher than a year ago. So there's a lot of excitement that, yes, we have this energy crisis, but this could really accelerate the process in terms of the development of the renewable sector. That is of relevance to Africa, obviously. The push to develop more renewables project is on across the continent. There is some debate and discussion around exactly how you go about that. But this can only mean that we will see more interest and more momentum behind trying to get the sector going. Of course, Nigeria is going to the polls February 25th. Elections for the Senate, House of Reps, President and Vice President, and there will be a new president. The current president cannot run again. And it's a some would argue, three-horse race between Bola Tinubu, who is the former governor of Lagos State. He's a kingmaker in the ruling All Progressives People's Congress, and seen as the successor to Muhammadu Buhari, who cannot run for another term. He has to step down. The expectation is that he will win. He's going up against the, I think it's six-time challenger, Atiku Abubakar, former vice president. He's running on the PDP ticket, the People's Democratic Party, former ruling party. And then there's a bit of a wild card in a guy called Peter Obi, who is seemingly in keeping with what we've seen in a lot of parts of the world, is sort of like the outsider who's kind of come in and seems to be quite popular among especially urban young Nigerians, of which there are quite a lot. And there's some discussion that he might shake the outcome a little bit. I don't see it. I don't think so. I think it will be a Tinubu victory. We'll see what the reaction is to any kind of perceived wrongdoings in how the vote is cast and how the votes are counted. That's always a factor to keep an eye on. Security is going to be an issue that's been raised as well. But whoever comes out victorious, and I do believe it will be the ruling party, long to-do list to tackle some core issues in Nigeria, a lot of them pre-existing, a lot of them very familiar to you. Some of them, more recently pushed to the forefront. Security has become a truly nationwide emergency. There's an uncertain economic outlook, and I think anecdotally, because of the emergence of this sort of third candidate, you can make an argument that there's increasing need for the political classes in Nigeria to figure out how they better appeal or how they can be more relevant to its very young, large population that obviously has some frustration with the incumbents. Security, just a couple of things on this. Bottom left, that's the Accra Initiative. That's the leaders from the Economic Community of West African States. That was in Accra, I think it was in November, and their focus is on the Sahel. If you've been following West Africa over the last decade or so, you'll know that that's a volatile part of the world. It's become more volatile. The basic story is that you have a proliferation of Islamist-linked insurgents throughout the Sahel, especially the so-called G5 Sahel countries. I believe those are Mauritania, Burkina Faso, Mali, Niger, and Chad. At this meeting where this picture was taken, the president of Ghana warned that all of West Africa could be engulfed. So one of the issues that has become more pressing is the risk of spillover. It's bad enough that you're seeing significant instability in the Sahel. You've seen military coups, you've seen military interventions by the likes of France there. But this is starting to spill over into some of these coastal economies, has been for some time. But it's getting to the point now where it's taking on greater urgency. So that's going to be an important one to watch because international efforts there have all but stalled. France is leaving, and France was kind of at the forefront of international efforts. It's not leaving on a good note. It's with a good riddance from the likes of Mali and Burkina Faso, who've both basically thrown the French out. And that's part of just general disaffection, popular disaffection with how France is perceived in the region, how its role is perceived. So there's a pulling back of international military efforts, counterinsurgency efforts, and at the same time, ECOWAS has struggled so far to really mount much of a response. That's going to be an important one to watch this year. Top right, similar but different situation. The East African community is gearing up to try and once and for all bring an end to decades of conflict in Eastern Congo. So there are negotiations actually, I believe it was in April, Democratic Republic of Congo joined the East African community formally. And late last year, there were negotiations in Nairobi. A deal was struck to start to try to demilitarize some of the eastern part of DRC, where there's up to 100 rebel groups targeted particularly at the M23 rebel group. But significantly, the EAC has also deployed a regional peacekeeping troop to eastern DRC. How they fare in 2022 is going to be important to watch. DRC is a critical country in more reasons than one. An added element that makes this complicated is that there is growing an open tension between Rwanda and Congo around this. Rwanda has for a long time been accused of funding and supporting rebel activities in eastern Congo. It denies that, but it's a bit of a sort of, one of those badly kept secrets. So that's an important one to watch as well, how those dynamics emerge. Final slide. This so-called great game is back in Africa. It's been a busy month. This is all from just January, which is kind of interesting. We had the foreign minister of China visit, followed by the foreign minister of Russia, Sergei Lavrov, and the US Secretary of the Treasury, Janet Yellen. They've all, over the span of the last 2 weeks, been all over Africa. Now, two things to say about these briefly. One, it's not a new Cold War. There are obviously elements and dynamics like that at play globally. I don't think they're going to play out in Africa in any meaningful way, not in the way that we have seen in the past, i.e. two camps and, it's either or, although I'm sure there is pressure to that effect. We're going to see more of this lobbying. This is literally just in the last 30 days, and all of these countries, when they visit their African counterparts, they always at least make some sort of comment about the other. Janet Yellen has not held back, for example, over the last week, calling out Russia and China repeatedly for being bad actors, and the feeling is mutual from their end. But I wouldn't say we should worry too much about that this year. That's part of the dynamic. The more important part of the dynamic is that you have a very broad base of countries that are doing this. It's not just the great powers. Got lots of fairly diversified interest from across the world that is now crisscrossing Africa, looking for relationships to build, deals to make. And I would say that that kind of characterizes the bulk of it. Now, I've been going on for way too long. Those are some takes on what to watch out for, some big picture stuff. So what I'm going to do now is hand over to my fellow presenters who are going to speak at a more technical level and a more detailed level. First, Emmanuel Kwapong. He's an African economist at Standard Chartered Bank, and he is going to give us a bit of an overview of the macro outlook. Emmanuel, the floor is yours.
Next one is yours. Great, okay, thanks. Good morning, ladies and gentlemen. Thanks for the introductory remarks, Larry. It's really a pleasure to be here with all of you this morning, really to talk about the outlook for the global economy and what really that means for Africa as we go throughout this year of 2023. So I will start with that slide, which is basically the cover page. Late last year, we published our flagship report looking ahead into the year 2023. And the title we chose for that report was A Year of Two Halves. And I think that really captures the key theme of 2023, one of divergence in terms of across time, where we think, in the first half of 2023, we're going to see much more weaker growth, and then a rebound in the second half of the year, but also divergence across region. And so if you go to this chart where we are showing the global growth, we expect growth to moderate to about 2.5% in 2023. And there's that distinction. We think growth will be much more weaker in the developed markets. If you look at 2023, you can barely see growth for the DM regions, much weaker, and really being driven by the expectation that the fight against inflation, which many of you are very well aware, is going to be from central bank tightening. That's going to be impacting the growth of those economies. Meanwhile, in emerging markets, we think growth will probably hold up in 2023 as well. We've seen growth probably flat. And a lot of that is going to be driven by Asia, in particular China as well, with the China reopening. And again, a lot of the speakers before me have highlighted a lot of the key themes we are going to be talking about. The China reopening clearly is going to be very important, and that's going to be driving a lot of the growth as well from the Asia perspective. I did talk about the fact that central banks will be fighting, continue to be fighting inflation. We do see that's impact in terms of tighter global financial conditions. Previous speaker talked about this as well in terms of what it means for financing in Africa. I think we'll touch a lot more on it when we get to the Africa space. But just to put it there, it will be a key theme for 2023. Moving to the next slide, we do see, it's just trying to see the implications of that China reopening for commodity prices. Clearly, that's very much important in terms of the commodity price dynamics for Africa, given the region's dependence on commodity exports, clearly very important from that perspective. We think, that the reopening in China is particularly good for metals. We're going to see some amount of recovery for metal prices. But in terms of oil, it's not that clear-cut. We think we're going to see some pickup in demand, clearly, obviously, from China reopening, but might not necessarily offset weaker OEC demand. So what is all this really just that scene setting in terms of the outlook for the global economy mean for Africa? Well, in 2023, we do expect growth to be about 3.7%, and that's rising slightly from about 3.5% that we had in 2022. But that really also does come with quite a lot of risk in terms of that outlook. we clearly see global growth moderating, which I talked about, possibly having some impact for the region as a whole. We, again, have talked about China. I think China's recovery is clearly going to be important there in terms of what it means. But even at 3.7%, it's worth noting that that's really subpar growth for the region. We have, in fact, had subpar growth for the region for a couple of years, and a number of reasons at play. Clearly, we've had a succession of external shocks, and that has impacted growth. But also, the expectation that the investments levels that we've seen over the couple of years are not going to hold up into the medium term. That also has been a play. We recently looked at the relationship in terms of the China-Africa relationship and how we think that's going to pan out. We think China is going to probably continue to engage with the region. It's going to continue to be an important sector for the region. We're probably going to see some continued investment from China into the region, but it's more maybe selective in terms of engaging countries or lending to countries that it hadn't previously been lending to, and that might also help. But I think the headwinds are worth noting. We've had some challenges clearly in 2022, and some of these headwinds are going to remain in 2023, inflation in particular being a challenge for a number of countries, as you see clearly on the chart to the right. Ghana does stand out in that, but a bit of that is also idiosyncratic issues, the debt restructuring and the impact on the currency, that pass-through from that really pushing that. But across the region broadly, we are seeing inflation elevated. And indeed, if you go to the next chart, our forecast for 2023 for many of the countries in the region, and that's on the right side of the chart. These are a number of African economies. For many economies, we're probably going to see inflation in 2023, average inflation higher in 2023 than in 2022. And if you juxtapose that to some of the developed economies where, for the likes of the US, where inflation has possibly peaked and is easing, we do see average inflation for many of those economies much more lower in 2023 than in 2022. So why that difference? A lot of factors at play, one being the fact that we are going to continue to see the pass-through from weaker currencies on inflation in the region. Food price pressures are possibly going to also continue to be at bay. We have seen food prices soften, and that was shown in the previous chart where we had the food price index FO coming down a bit. But I think still there are some domestic issues, domestic supply issues that need to be addressed from that perspective. And given that food is a big important basket in the region CPI basket, we're probably going to see the impact there again being quite more significant. For central banks in the region, that means that they probably need to tighten a bit more to really make sure that inflationary pressures do not become entrenched. And that's also will probably mean that there's going to be some impact on growth from that channel as well. Another key theme, I think probably the major theme for 2023, and this is something, again, previous speakers have touched on, is how the countries in the region are able to manage their financing, particularly in terms of external financing. Over the years, we have seen many African countries tap the international capital market to raise financing for much critical investment spending. And this really happened in the period where global interest rates were much lower, global financial conditions were much supportive of growth. But what we have started to see since 2022, as global central banks have been fighting inflation, is really tightening of those financial conditions. And in effect, it has meant that many countries in the region have lost market access. We probably will not be able to return to the international markets near term until we see quite significant compression in yields. We have already seen the fallout from that, what that has meant for a number of countries, in particular for Ghana, where they have opted to go for default, given that there was very limited options in terms of financing. I think from that perspective as well, it also means that for many other countries, they really need to start to look at what other sources of finance and diversifying sources of finance they possibly could have. It's a very, very difficult backdrop in that sense, against a time where, we have more, over the next 2 years, we have quite significant maturities coming due. Those Eurobond issuances over the previous years, quite significant maturities on that coming due over the next 2 years. And that really means that we're probably going to see a big focus in terms of what's happening on external financing, what are the risks around debt management, debt financing over the next couple of years, particularly towards the latter half of 2023. And so I guess, again, another key theme is the theme of, given all this, what does it really mean? How do countries really differentiate themselves? And we think it's the impetus for reform in the region is particularly greater now more than ever. We think, the better rated credits would be the ones that will be able to return to markets. We have seen a deteriorating trend in terms of credit ratings for the region. Just last week, we saw Nigeria being downgraded by Moody's further. And clearly, a lot of challenges at play, but it's really, our key theme is that there needs to be more of the reform measures being done. In the case of Nigeria, we talked about the elections coming due in February. The key message is that, or the expectation is that across the board, following the elections, we probably see some of the much needed reforms on energy subsidy, reforms, and that's particularly fuel subsidies, but also reforms on the FX situation to help. We are having a growth, we have growth picking up in 2023 for Nigeria, 3.5% from about 3% we estimated for 2020. And it's partly or largely got to do with the oil sector growth. We saw oil output in Nigeria contract quite sharply in the first 3 quarters of 2022 for a number of reasons, in particular oil theft being quite critical. We then started to see it bounce back a bit in the last quarter of 2022 as the authorities really started to tackle some of these issues. We think that, in 2023, oil production could possibly rise to about 1.6 to about 1.8 million barrels per day. And that would mean that the oil sector does get some boost to growth. But the non-oil sector's outlook really depends on the implementation of these reforms that are much needed to boost the economy. So probably in the second half of the year, after we've had a new government in place, possibly those are the timelines we are looking at in terms of real reforms being able to start at any point before then. Again, still on the story of reforms, if you take the South Africa, for instance, as well, where we've recently had to downgrade our growth forecast, it's got to do a lot with the energy situation there, power sector load shedding, and that's really going to be impacting economic activity. We've had to downgrade our growth forecast to about 1.5%. But broadly in the region, I think clearly countries that are able to differentiate themselves by moving really with the impetus for reforms, those are the countries that really will be able to stand out to have a chance, and in terms of really being able to get financing from that perspective. It's key that they do this now. There isn't much of an option where previously you could have easy access to financing to support public spending and then to boost growth. We aren't seeing much of that now because financial conditions are tight and there's a need to do that. So maybe I am aware of time, so just to sum it up, 3 key themes to take away, 3 themes to take away. The first one is that global growth is going to be moderating in 2023, and that means that there are risks to the recovery in Africa. Tighter global financial conditions clearly mean that for many countries, financing will be a key focus, how they're able to access external financing, how they're able to meet alternative sources of financing, be it from multilateral, be it some bridge financing, for instance, will also be very much in focus. And lastly, really there is that need or that impetus to implement those much needed reforms to support medium-term growth, to diversify themselves, to stand out in terms of being able to access finance. I'll leave it here and then clearly open it up when we have the question and answers, and I'll leave it to the next person.
Great. Thanks, Emmanuel. Very important to unpack the debt and financing issue there. I couldn't agree more. That is one of the key things to watch, and it'll be interesting to, one, see how governments respond, but also pick your brain a bit later on about what we need to see happen there. I'm going to hand over to Tellef Tollefsen, the CEO of Norfund, and he is going to give us a development finance perspective.
Thank you, Landra. Good morning. It's a bright sunny day outside, freezing cold. So good to see you all, many familiar faces. Good to be here. I've been asked to address 3 topics this morning. The first is sort of the current state and priorities of development finance. Secondly, our Norfund's priorities in today's markets. And thirdly, the outlook for climate finance in general. So I've got 15 minutes, so I'll have to focus on a few points. When it comes to the key trends that will shape development finance, I'll highlight 3 areas. The first being that, in general, right now, there is a stronger need for development finance compared to earlier times, simply because funds are pulled out, as was addressed earlier this morning. The general private investment flows seek safety, so there's less international capital available for Africa and for developing countries in today's market. Secondly, we are seeing a growing pipeline of interesting investment opportunities in many developing countries. Countries are recovering post-COVID. There is more optimism in many countries, despite some of the bleak pictures you heard this morning, and albeit at different speeds in many of the countries we're seeing. And lastly, for development finance institutions like ourselves and also many of the multilaterals, we're seeing that climate is becoming increasingly important in our work. Quickly, when it comes to the capital flows, we've seen over the years that there is a clear correlation between or corresponding drop in foreign direct investments in developing countries when interest rates come up. So we're seeing now, during also late last year with the Ukraine war, that this was further exacerbated because investors seek safety when you can get decent returns in US dollars by simply buying government bonds, so by placing your funds in the bank. There's less risk appetite, so funds are pulled out. This is not just about Africa, it's about all emerging and developing markets. And the final numbers for 22 are not ready, but clearly that the investment flows were not as high as they would like to see them, which means that institutions like ourselves have now a particularly important role to play with the public funds that we are investing. Secondly, when it comes to growth, I've stolen this chart from a local investment fund here in Norway. But what you're seeing is that, yes, 3.7% growth in Africa is not good enough. It ought to be higher. And sadly, many African countries are growing at a lower speed than what we need to see to keep on pace with the population growth. But bear in mind, there's no growth in Europe these days. There's hardly any growth in the US. There's high growth in Asia. And many African countries, and look at those stats, are growing along the lines of Southeast Asian countries. So we tend to have these sort of bleak view of African markets. Yes, it's tricky. Yes, it's challenging. Yes, it's difficult. But that's where the growth is, right? The growth is not in Europe. Our population is coming down. And in the US too, it's tricky. It's a difficult country to invest in. There are huge opportunities. Bear this in mind. And we keep on always sort of focusing all the challenges. When it comes to climate finance, it's a good thing that we get increased funding and that there's more, obviously, a heightened interest in terms of investing in renewables. We need it, we do it big time. But there's also risk that it's all about climate. And we do need funding for other areas. We do need funding for education. We need funding for health. We need funding for investment opportunities in other sectors as well. So for us, it's a bit of a balancing act because we're happy to get funding and we need funding for renewables, but we keep on also having to try and tell our politicians that development finance is also important in many other sectors. So there's a bit of a balancing act, and there's a risk these days also because climate funding is also clearly in self-interest because, I mean, we all live in the same globe, obviously, but we need funding also for other sectors. So that's a sort of a bit of a challenge that we have when we speak to politicians. We in Northern, we've been trying to be counter-cyclical in the way we've been investing over the last few years, meaning that we've been stepping up our investment year on year. We've been able to do that partly because we have been able to recycle funds. We seek to sell out when we can, in the sense that when private investors can take over our holdings and keep on running them in a satisfactory manner, we like to sell out because we make more of a difference when investing early than just sitting on holding assets forever. And that's been particularly the focus on the energy side, where the average holding period for us is around 5 years. It was just announced this morning by Scottic that a large energy project in South Africa, Uppington, is being sold out. We are part of that. So that's the way we think. If we can sell to institutions, that when we de-risk the case, we can recycle those funds. So that's important to us. So when you look at the 22 numbers, it's about 6.2 billion NOK. We also provide some guarantees. In total, it's about 6.5 billion. You see at the bottom part, there's renewable energy. That's the new climate fund that I'll come back to. Otherwise, it's spread out on the sectors that you're seeing. Then, as to Northern's priorities, traditionally, Northern has been around for 25 years as of last year. We have traditionally been working on a development mandate, as you see to the left there, where the key focus for us is to create jobs and improve people's lives by strengthening the private sectors. And our task is to help companies to become sustainable and profitable. And we are always a minority investors, a maximum 35% normally is what we do, up to 49%. Then last year, as of last year, we also got a climate investment mandate in parallel with the development mandate. Under the development mandate, we've all along been investing in energy because energy is key to job creation. It's key to the provision of electricity is key. So that's been important to us. But under the under the climate mandate, we focus on those countries where we can maximize the climate effect, i.e. countries that otherwise build our coal-fired power plants. It's at a very fast pace. So those are the two mandates. So I'll start off quickly on the development mandate, where we concentrate on investments in 4 sectors. So we keep on investing in renewables. We do large scales, IPPs. We do commercial and industrial power solutions. And we do distributed off-grid energy solutions to households, to villages, to individuals. So we do all those 3 areas. Then financial inclusion, meaning financial institutions, microfinance, and other types of fintechs and the likes is also important to us. So those 2 are the largest sectors for us because we see financial infrastructures being key to development. So as such, that's important too. Thirdly, we invest in what we call scalable enterprises. It's either that we invest directly into agribusinesses or manufacturing, particularly in Africa, or that we invest through funds like Helios that you hear from later today and other types of funds that on our behalf invest into companies and help them grow. And for us in Africa, the agribusiness value chain has been particularly important. And there we very much focus on players that can provide storage, logistics, or primary agriculture players that also do a large part of the value chain. But we lately also been moving into manufacturing, such as textiles and others, because we see that as important for job creation and an area that we're increasingly investing into. Lastly, green infrastructure is a new area for us. There we're aiming at building up, still relatively small, waste management, water, recycling, and the likes. And there we particularly focus on urban needs in that area. So those are the 4 areas that we focus on and are our priorities. We target certain countries, meaning that we have about 30 countries that we see as core for direct investing. In Africa, we have offices in Accra, in Cape Town, and in Nairobi. And from those hubs, we focus our investment areas, so the Western, Southern, and Eastern Africa. And that's where we build direct relations. We have local teams, and we focus on those geographies. It doesn't mean that there aren't needs elsewhere, or that there are lots of opportunities elsewhere. It's just that it's limited how much we can do. It's limited where we can have a presence, where we can meaningfully build networks. So as such, we limit ourselves to certain countries. So those are the areas on the development mandate. Then moving on to the climate mandate, our focus there is clearly to be investing in renewable energy, and there we mainly invest in a large-scale sort of megawatt type of projects. We expect to be investing around 90% or so plus into pure large-scale energy production, such as solar and wind and some hydropower. We believe that solar and wind will be a lot bigger than hydro. We quite like to invest in hydro, and often over the years it's done a lot within hydro, but it takes longer. It's harder to get projects done, and the capex needs and the challenges to make it happen is tougher. And there's so much more going on in wind and solar these days. In addition to that, we will also be investing in some enabling technologies, such as storage, such as green hydrogen. We're looking into a few projects these days, and transmission. We just announced the transmission investment in India, where we can connect solar parks, for instance, or wind farms to the grid, and thereby helping the sort of to the green transition to make happen. Under the climate mandate, we're not, like in Europe, it's all about a transition, i.e. to change coal-fired or fossil power production to renewables. In the markets where we focus under the climate mandate, and in Africa, it's very much South Africa, it's more about avoiding coal-fired power plants to be built rather than closing down and then moving it onto renewables. We wish we could do both, but because in countries with fast growth, it's more about avoiding new emissions. Like in India, I mean, India alone will be building up about as much new energy capacity over the next 20 years as we today have in the European Union combined. And if we aren't able to make that green, we have a very, very big challenge. So that's where we focus. As you all know, I mean, there's a massive lack of access to electricity still in Africa. There's around 600 million people to have access to electricity, and the numbers are unfortunately growing because of the population growth. But over the later years, a tiny fraction of the global renewable investments went to Africa, less than 1%. And still, investments in renewables are about 1/3 of investments in fossil, and still being subsidized in many countries. And in 21, it was like $29 billion invested in fossils in Africa and about $9 billion into renewables. So we need to change that, obviously. And when you look at where renewable investments are being made, South Africa is clearly big, Morocco, Northern Africa, and it's still limited in many other African countries. Bear in mind, though, that Kenya and many Eastern African countries have a high renewable share, and also these days have, surplus energy productions. There's not there are different needs in different countries, but still a lot more need to be done. And there are some companies here that are clearly involved in it and to make it happen. Lastly, then, when it comes to the outlook for climate finance, the biggest challenge we face in Africa is the fact that most African governments fail to provide satisfactory structures meeting the requirements from international investors. There are a few countries like South Africa and others that have auction schemes, that have licensing schemes, and have processes that are transparent and work out, and other countries too. But far too few countries are able to provide sort of the safety and the mechanisms and the transparency that international investors need to see being in place to sign up to long-term power contracts, and also to have reputable entities that they can have as a counterparty in the contracts. So that's a big challenge. And obviously, the return requirements, the fact that the dollar has, the rate of returns globally have gone up, or the return requirements have gone up, is also a challenge these days. But that's not something for Africa alone. That obviously that plays in everywhere, but it makes it even more difficult these days. And then the Inflation Reduction Act in the US that's being debated a lot. It's a funny acronym, by the way, IRA. That's And also we're seeing increasing subsidies now being pushed forward in Europe to counterbalance the IRA in the US. In one way, it's a good thing because funding is now being channeled into renewables and into new technologies. But the bad thing is that it means that global investors see it increasingly attractive to be investing in the US as opposed to investing in Africa or in Asia, in emerging markets. So we see it very much as just a sort of a trade-off or a sort of a fight between Europe, US, and China. But for those countries that can't afford to, as was presented in terms of the balance sheets, we look at the balance sheets of Ghana and others, there's no way that they can subsidize along the lines we're seeing in the US or Europe. Well, the US can't really afford to do it, they just borrow money to do it, but still, they keep on doing it. And funnily enough, it's called the Inflation Reduction Act, and they're pouring out lots of money. So it's a funny way of presenting it, but still, that's a challenge. Then, lastly, despite those challenges, a lot is going on, particularly in the C&I sector. It means commercial and industrial, which are contracts that you sign up to private counterparties, more so than having a state utility signing off on contracts. So there's a lot going on there, and also on the distributed area. But we want there also to be more in many other countries when it comes to the large-scale IPPs. Quickly, climate finance is obviously not just about renewables. There's a lot more to climate finance than renewables. It's very much within adaptation, within resilience and risk mitigation. And we are increasingly looking into those areas, particularly within adaptation and resilience. Well, we need to understand the risk and we need to mitigate the risk. But when it comes to adaptation and resilience, we look into opportunities within agtech. That could be resistant seed variants, as an example, flood and drought protection, but also within financial institutions. We look into insurance schemes, microinsurance and the likes, where we can help individuals, companies to better sustain the effects of the climate crisis and global warming. So those were a few trends, few things from my side. I've spent my time, I can see, so thank you very much.
Thank you very much, Telef. There's a few things to unpack in that, but the takeaways from my perspective are renewable energy and climate finance and investment. And just so that you can start thinking about it now, I'm going to pick your brain later on about what the outlook is in those areas specifically, if you can say anything concretely about this year when it comes to Africa. Anyway, moving on, we have a couple more presentations. Next is Dami Lalude, who is Senior Vice President in the investment team at Helios Investment Partners. She's going to be giving us the investor perspective. Dami.
Can you hear me okay? Okay, great. Good morning. It's a pleasure to be with you today. In my presentation today, I will start with a very quick intro on Helios, talk briefly about the macroeconomic backdrop for context, then touch on where we see growth opportunities. I think my mic might be falling, by the way. Okay. Then touch on where we see growth opportunities on the continent from an investment standpoint. And finally, I'll touch specifically on climate and green growth and the opportunities that we see there in Africa as well. So briefly on Helios. Okay, so Helios is an Africa-focused investment firm. We manage approximately $3 billion in capital today. The firm was founded in 2004, and over the years, we've raised 4 private equity funds. We also have a private capital. Sorry, I think my mic needs to be adjusted. So just to recap, so Helios is an Africa-focused investment firm, private equity funds and private credit. More recently, actually, we've evolved to also set up dedicated thematic strategies where we see large opportunity. So we launched Helios Climate, which is our climate-focused fund. And we also have Helios Digital Ventures, which is our venture capital strategy. Our mandate is Pan-African. So our portfolio spans over 30 countries across the continent. And we have a key presence in Lagos, Nairobi, London, and Paris, where we have offices. So with that, I will now turn to the current macroeconomic backdrop for context, although I'm conscious that prior speakers have actually said a lot of the key messages here. But I think, like Telef, I share the view that whilst there's often a lot of doom about the Africa outlook, it's important to put it in context. So I think the key point to highlight here first is that from an African perspective, the economic slowdown is actually not as pronounced as elsewhere. So when you compare current levels to historical ranges, you actually see this trend quite clearly. And going forward, we think that the conditions are actually less uncertain on a relative basis. So let's start with inflation. Comparing pre-pandemic levels in the decade up to the end of 2019 to today, inflation in the US and the Eurozone actually averaged 2.2%. Today, it's 8.2%, right? For Africa, it's risen from 7.6% to 11.2%. Now, while 8.2% is well outside the norm in the US, in Africa, 11% is not, right? And then next, if you look at policy rates for the Fed and the ECB average 0.6%, again, in sort of the period, pre-pandemic. Today, they've almost quadrupled, right? In Africa, things have barely moved, roughly around 10, 11%. And finally, the rate of change of the economic outlook is also very different. So here, we're not looking at the average pre-pandemic level, but really looking at the change in the forecast GDP growth at the start of last year compared to the current view. In the US and Eurozone, it was 4%, and now it's 0.2%. So that's a massive step down. In Africa, forecasts were also around 4%, and today, like was mentioned earlier, it's still sort of north of 3%, close to 4%. So some step down, but not as dramatic. So overall, I think I would say that high inflation and high interest rates in Africa actually is not a new environment. We're used to that, and the economy has continued to grow against that backdrop. Now, having said all of that, Africa is not immune to the instability. Now, GDP growth can often mask some of the key challenges that I think we need to acknowledge. As has been mentioned before, again, portfolio outflows and rising import bills are creating current account imbalances across key economies on the continent, and there are questions around sustainability, right? So, weak current accounts are putting pressure on exchange rates. Most African countries are actually net food and fuel importers. So in these economies, food and fuel account for a larger proportion of household expenditure and the CPI basket. So domestically imported inflation is putting pressure on households. Externally, as well as has been discussed, before, there's an issue around sovereign debt and the sustainability around, the ability to actually service that debt. So I think that for sure, as we look ahead, there are risks to growth. Now, I won't spend much time here, but I think it's interesting to actually highlight that when you map the domestic vulnerability, so here we're looking primarily at inflation, to the external vulnerability, and here we've taken current account and debt service indicators. Several of the continent's larger economies, key economies, are actually, appear to be at greater risk. So the risk is not skewed to smaller economies as you think about where to invest on the continent. But taking a step back, just to summarize the overall backdrop. So one, like I mentioned before, we think that the outlook is actually less uncertain in Africa compared to developed markets. Secondly, fundamentally, Africa remains very much a growth story, right? And that's in contrast, with the US, where from an investment standpoint, close to 60% of returns will come from, for example, multiple expansion. In Africa, it's really about earnings growth. And we do think that as the world shifts to a different economic cycle, relative valuations will become more important. And against that backdrop, economies like Africa will become or should become more attractive on a relative basis. Now, I'll move on to talk about where we see growth on the continent and opportunities for investment. I would preface this by saying that this has been refined over the years, many lessons learned, some scars as well. But we do think that this strategy now is, aligned to what we see as reality for investing on the continent. So our selection of focus sectors is very much aligned with the key mega trends that we think are, sort of long-term, uninterruptible in Africa. And those are demographics and urbanization and technology and innovation. So without doubt, Africa is a dominant source of labor force growth. The rise of cities continues to spur productivity and consumption growth. And on the technology front, we think improving affordability is generating leapfrogging opportunities. So our focus sectors, are around digital infrastructure, financial services and technology, tech-enabled services, consumer non-discretionary, clean energy and power. And our portfolio reflects this sort of range of sectors. Now, more broadly from an investment standpoint, I think resilience is absolutely key, in Africa. So one, we look for businesses that actually benefit from secular trends and not cyclical growth, in Africa. Second, huge point, FX, right? So we look for businesses that are FX protected, and that means that they either earn revenues in hard currency, operate in currency pegged zones, or have the ability to actually pass on currency devaluation or FX changes to the consumer. Three, high growth rates at multiples of GDP. So in effect, you have to be able to outgrow inflation and currency devaluation. And we're very disciplined about capital intensity, which we would only do where there's high revenue visibility. Now, if I compare the value creation opportunity and reality in Africa to investing in developed markets, I think there are a couple of stark differences. One is that we would typically invest at lower valuations. So, 5-year average in Africa will be around 9 times currently versus 11x, in the US, for example. Our portfolio companies use far less leverage on average, which means that, as I mentioned earlier, earnings growth really is the fundamental driver of value creation, and that speaks to the importance of resilience through the economic cycles, and that being so fundamental. So in the final section of my remarks, I will touch on the climate and green opportunity in Africa specifically. We do think that the next decade in Africa is the climate decade. Historically, the story has been largely around renewables and energy access, as Talof mentioned in his presentation, but that's only the tip of the iceberg. We think that going forward, while renewables, cost curves will continue to drop, the opportunity is actually broader across sectors of the economy. And ultimately, growth is an imperative for Africa, right? So the challenge really is to decouple economic growth from rising emissions. It's not either or, and that's why we think green growth is really fundamental going forward. Now, we see a lot of opportunity to invest in low-cost, reliable, sustainable green solutions across a broad range of thematic areas. And that spans renewable energy, food and agriculture, transport and logistics, resource efficiency, climate tech, and enablers. And we see scope to invest in both mitigation and adaptation, although adaptation, I think, not just in Africa, but globally, can often be challenging from a commercial investment standpoint, but nonetheless, we think that it's critical in Africa, particularly around agriculture, and we intend to explore opportunities to invest there. On the mitigation side, we think the story in Africa will largely be around avoided emissions, and that'll be a key component of the pathway to net zero from an African context. And finally, I would say that from a value creation standpoint, we do think that there's scope to capture a green premium, including in Africa, by building African businesses that can not only contribute to the climate agenda domestically, but also to global, sort of commitments on the climate front. Ultimately, there's no net zero without Africa or other regions. It's a global ambition. And we are building an intentional approach at Helios to partner with companies to achieve that. So with that, I will end my presentation. Thank you.
Thank you very much, Dami. I appreciate the bullish perspective, that it's not all doom and gloom in Africa. When you put it in context, there's more than meets the eye. And I do want to hear more about that. I suspect the room wants to hear more about that as well. And it's not bullish for the sake of being bullish, which I think is key. Final presentation for now. Same Shinura of the Africa Finance Corporation. Same, the floor is yours.
I'm the last speaker. I think Mathilde and the NABA team had two options: either distribute antidepressants after what we've heard, or have a lot of alcohol outside at 10:30 in the morning, or have me on the podium. I think you made the wrong choice. Actually, I want to take you from the 10,000 feet to the 1,000 feet. Because if I want you to walk away today with a few messages, they are resilience, opportunity, profit, and impact. It is not all gloom and doom. And what we do at AFC can prove that to you. I'm not going to go through, I have a few slides on the macroeconomy. I'm not going to go through them because I think you've had an overdose of that. But I want to tell you our story and what we do at AFC. AFC started 15 years ago with a group of governments, African governments and African banks putting $1.1 billion together to invest in infrastructure in Africa and to make a difference and to be transformative. We closed last year with $10.7 billion in a balance sheet with no money put again from the shareholders. This is how profitable you can be in Africa and impactful as well. So as I said, we are owned by governments and owned by banks, so it's a PPP structure. We have about 40 countries that are member countries, which is a good thing because this gives us immunities, protections in terms of expropriation, in terms of distributing dividends, getting money out, not being sued for any reason, obviously other than fraud. But it is a very good vehicle in terms of being on the ground, knowing our markets very well, having the right contacts, having access all the way through to the top of the country, whether it's the president or the prime minister, and getting things done. And this is what Africa needs. I'm not going to go through these slides. But I want to just take you on a tour to AFC and what we do. So we cover a number of sectors. We are an infrastructure investor. We do debt, we do equity, and we do everything in between, whether it's acquisition finance, project finance, trade finance. But we have a number of focus sectors, heavy industries and telecom, and below each one of those we have subsectors that we focus on. Natural resources, and we cover oil, gas, infrastructure, gas exploration, transition metals or battery metals, and pressure metal mining. On the power side, we have power generation split into gas and renewables, and we're going to cover renewables. We were a small player only 2 years ago. Now we're the largest renewables player in Africa by far. Transport and logistics is a very important one for us because the way you think about this, one of the biggest challenges of Africa is supply chains. You have a lot of products, whether they're agri products or they're minerals, They are in the middle of nowhere. You have to transport them, you have to add value, and then you have to get them to a port to export them. So we invest across the full supply chain to make sure that the product is exported and value is added. And then finally, product solutions. So we do sovereign lending, we do trade finance, and a few other things, including insurance. Now, the interesting thing is that we have a very strong project development team. So we take early stage risk. We can invest the first few $1 million to make the project bankable, and which automatically brings people to be interested and attract other investors into the project to financial close, then construction, then operations. Sustainability cuts across all of our sectors, and once we make an investment, we have a portfolio management team that oversees it. We focus on 3 areas. How to localize. So if I tell you that 6% of a battery in a car, or even less, is actually the mining part, and this is the only thing that is done in Africa. How do we capture value? How do we localize? How do we stop exporting cotton and export garments? How do we stop exporting cocoa and export chocolate? So all these things are things that we think very hard on, and we actually invest to make sure that we localize the industry within Africa. Infrastructure is one of the biggest challenges we have in Africa. How do we build infrastructure that is resilient? How do we build greenfield projects that is resilient? How do we think of, if we're building a port today that was going to live for 40, 50 years, should we add another 60, 50 centimeters to the quay wall? Or should we do it the traditional way, and then 10 years later, we have a problem? So these are the things as well that we invest into, and we have actually a dedicated fund that invests into resilient infrastructure. And then pure vanilla infrastructure investments is not something that will work in Africa. You need to be innovative, you need to find interesting financial instruments to be able to innovate and invest. Okay, these are the themes that we are focused on: climate, integrated supply chains, energy, food security, telecom, and technology. I want to only, given the time constraint, I want to focus on only 2 of them. So let's start with climate. As I said, only 2 years ago, we had at AFC, we had 3 projects in the renewable energy of 130 megawatts. Over the last 2 years, we have made a number of investments in wind, solar projects that have taken us to 1.4 gigawatts of power. The issue with Africa is that you only find in renewables 50 megawatt projects, 40 megawatt projects, 100 megawatt projects. These are too small for large-scale investors, and I'm sure Telef will understand that. What we have done is that we have said we're going to group everything together. It's an aggregation play. We need to be a large-scale player so that when the company or the platform is big enough, it will appear on the radar screen of many large-scale investors and will attract third-party funding into the continent. Telef talked about exiting. They only exited because they executed on the projects, but they have a group of projects as well that are big enough to attract other investors. We're doing the exact same thing. Once we got to the 1.4 gigawatt, and as I said, became the largest player in Africa, governments came to us and said, please help us build this. Developers came to us and told us, we cannot do this on our own. Can you please come and invest alongside us and develop the projects with us? So today we have 1.4 gigawatts of operating assets, but we have a pipeline of 13.7 gigawatts of pipeline. The objective is for us to grow this platform and get it to a point where it's scaled to a level of 3-4 gigawatts, and then we can list it on the London Stock Exchange or any international stock exchange and achieve another mandate that we have, which is attracting third-party capital into the continent. They will not invest, the large players will not invest in a $20, $30 million project, but they can invest in a diversified portfolio of assets that are managed in one platform. I've spoken about the fund that we are raising for resilience and infrastructure, and the idea there is to invest in projects that require some additional infrastructure, because you need to know that Africa contributes 3% of the emissions in the world, but it's the most affected continent in the world in terms of climate change. 6 out of the last 10 natural disasters in the world happened in Africa. So you need to build the infrastructure to withstand that. And we're putting together a fund to invest in that. Battery metals. I love this slide. It's the most embarrassing slide for Africans. I am African, I am from Egypt, and I find this very embarrassing. 40% of the battery metals in the world are sitting in the ground in Africa. Who controls the battery manufacturing market? China. 70% of the batteries in the world are produced in China, closer to 80 now. So what happens is that in Africa, we extract the different minerals, we export effectively rock to China. China produces the batteries, they export it back to Europe and the US to install it in the cars. Now, every time my team comes to me with a problem, I tell them, give me the solution. So here is the solution. If you look at how a battery is manufactured, you go through 6 or 7 steps. The only step that is done in Africa is mining. And this is an $11 billion market. The battery minerals, the electric car sector, is a 7 trillion market. So our challenge at AFC is, how do we capture value? How do we go into steps 3 and 4, or 2 and 3? We know that in Morocco, there is car manufacturing. Her Excellency is here in the room. So these green dots there at the end, there are car manufacturing facilities in Morocco, in Egypt, and in South Africa. But how do we capture the metals and precursors? If you move from 1 to 3, you capture 40% of the value. The other point, if I want to go back here, if shipping was a country, it would have been the 6th most polluting country in the world. So if you capture a few of these steps, you reduce the shipping that is needed to export effectively rock, and then refine it and produce the final product. So we are, at AFC, we're focusing on how do we add value, how do we reduce emission, and how do we create jobs, obviously, and have impact within the continent. So this is the big picture. The way we do it is that we've structured a company that focuses on mining, metals. It's split into gold and battery metals. And effectively what we want to do again is to put all of our investments into these companies in that sector and attract third-party capital. So the message to you is that first, the opportunity is there. Yes, the macroeconomy is not very promising, but if you move from 10,000 feet to 1,000 feet, you will find opportunities. It is amazing how, even though the countries might not be doing well at the macro level, you will find opportunities at the micro level where you can have an impact and actually make a lot of returns. Thank you very much.
Thank you, Sami. Another bullish take there. I'm going to come back to you, though, on how some of this might play out in the next 12 months. Because what I'm hearing there is that's very big picture, some of it long term. So we're going to come back to the short term. Okay, we're going to have a bit of a switch around here of the stage. We're going to get some tables up here, because what happens now is we are now going to go into a discussion about some of the points that have been raised. Let's get the tables up here. Okay, so here's what we're going to do. We're going to unpack some of the some of the points that have been raised a little bit. And then we want to get you involved. We would like to hear your comments, your thoughts, your questions, because we have covered quite a lot of ground. We're going to cover a bit more, and then we want to also hear from you. I've been told I need to stand here. Feels a little bit impersonal, if you don't mind me sort of, edging in on the panel here. Okay, thank you so much for the opener, for the scene setter. A bit of a mixed bag. Some of the analysis not so encouraging, but there's still plenty of opportunity out there when it comes to Africa. I want to start with that theme of what separates the bullish perspectives from some of the let's say more cautious perspectives about Africa. And Dami, I was really intrigued by your take on this. And the word that stuck out for me was nuance. Yeah. If you look at it just from the headline figures, Africa doesn't look great. Honestly, Africa hasn't looked great for a while if you just look at the headline figures. To the extent that you can, more than you did in your presentation, how would you break that nuance down a little bit more? So let's say, hypothetically, you're looking at Africa, you're like, well, where do we go? What do we do, right? Do we invest by market? Do we invest by region? What's the opportunity in 2022, if you could break it down for us real quick?
Sure. So I think first thing to say maybe is that there's a nuance between the public investor perspective and the private investor perspective. So as private investors, we take a longer term view, right? And so we are, and like I mentioned in my presentation, we are looking for opportunities where there's the scope for long-term growth in a sustainable way. And often actually, I think like Sameh alluded to, despite the noise and the gaps and the short-term policy shortcomings, what we see is that it's a large market across the board. There's scope to actually innovate and produce products or services at the right price point in a way that is scalable, addressing specific gaps, of which there are many across different sectors, right? So I think for me, it's not even so much, like if I don't think there's an opportunity in the next 5 years, I'm not investing today anyway, right? So I think you have to take a more long-term perspective, look for the gaps, and really, I think, align the provision of services and products to the market, and that means that price points are key. That means that the mass market rather than niche segments is key. And like I mentioned earlier, that means that actually sustainability and the ability to through the cycle be resilient, whether that's been able to pass through cost increases or be inherently sort of mitigated through your business model is key.
You don't see those fundamentals having shifted in any meaningful way over the last 18 to 24 months?
So I think, as I think about our portfolio companies, of course, there have been short-term effects, right? From a supply chain perspective, the cost of debt remains sort of high, both in absolute and relative terms. So there are those headwinds, but I guess in a way, whilst perhaps for a period it was exacerbated, a lot of those are actually not new in our environment, right? And so I think fundamentally you have to take a longer term view, and you have to sort of invest right, and that means finding the right sort of business models and the right sort of gaps in the market to play in.
Okay, all right. Overall, 2023 for you, Africa, good year, bad year, average year?
I think hard to tell, but like you mentioned, I think China reopening is good. And I do think that on the political front, right, we've had South Africa and Kenya go through their cycles. Nigeria will come, as you spoke about. But by and large, we don't actually expect that to sway the picture. I think it should remain directionally pro-market, albeit with kind of, its nuances and challenges. And it's about figuring out how to navigate that, like I've kind of described earlier.
All right, I'll follow that one under uncertain.
Well, uncertain, but again, I would emphasize that it's not about just it's about a more fundamental longer term view, and we still see opportunity against that backdrop.
Got it. Emmanuel, you spoke about, and this I think was really important, the way in which African governments have effectively been locked out of international capital markets, right? We saw that in 2022. It doesn't look like that's going to change significantly in 2023. And a lot of countries have already announced they're going to shelve plans to issue Eurobonds. They don't want to go there. They want to look at concessional lending, domestic borrowing. This puts potentially quite acute pressure on governments, as you said in your presentation, to carry out some basic critical investments, right? The longer this drags on, how much of an impact is that going to have on these critical investments that we need to see from governments this year, but also longer? Do you see this being a medium to long-term thing, or can we expect things to normalize in the not-so-distant future? What does it mean for spending?
Now, that's a good question in terms of public spending. I think I highlighted some of this in the presentation, where we have moved from a period where some countries had that fiscal space to be able to borrow to support the spending. In some places, rightly so, in terms of the much needed public infrastructure spending. And for many of the countries that we are looking at across the region, that space really is curtailed now. So how do governments really come up with ingenious ways to really still meet those funding? And I think the private sector has talked about some of the issues there and how they could possibly be looking at more other ventures such as the PPPs that have been talked about and the likes. But in terms of financing, yes, you're right that it's still a very difficult backdrop. We have seen some emerging market economies at the start of this year being able to return to the markets to issue more better credits. But I think for Africa, that we haven't yet seen any there. And for many of the economies we are looking at, even the much stronger credits like Cote d'Ivoire or even Senegal, probably we might need to see some more compression yields before they might consider coming to the market. What does that mean? It means that they probably need to look at other alternative sources of financing, yes, but also on the fiscal consolidation front. Over the last 3 years, in many economies, we haven't really been able to return to that fiscal consolidation drive. For obvious reasons, we've had a shock. Governments have had to respond to the shock to save lives. So it's been a difficult challenge, and going forward, it's really going to be a much more difficult balancing act. How do I, still support the social spending that I much need, while also ensuring my debt remains sustainable over the medium term? And that's really going to be the big challenge for 2023 for a lot of these countries.
Do you think things are going to be better or worse, or let me put it differently, more challenging or less challenging 12 months from now?
I think to the extent that reforms are implemented for those countries that do that, the outlook would probably be much better from that perspective. But for those that don't, then, and those that are where debt, again, we've got high risk of debt distress in many countries. For those that don't really go that channel, there isn't much option in terms of how they channel their way through. We need to deal with the fact that, as much as we think we're nearing towards the terminal rates in terms of peak monetary policy tightening for many countries, and possibly we start to see some cuts over the short term, it's unlikely still that we go to levels or for African countries go to levels where they used to be able to borrow before. So that's a real challenge, and they need to deal with that. They need to be able to, from the government side, deal with issues such as raising revenue on the domestic front to be able to contract or to narrow some of these fiscal pressures that are going to be appearing over the medium term.
For sure. I guess the hope is that these factors ease faster than expected, because the longer this goes on, presumably the more pressure it's going to put on African economies as a whole. Telef, and really this is something that stood out from basically all the presentations. It's all about renewables, climate funding, climate finance, the green transition, the climate decade, which I like. We're actually moving out of renewables into the decade of climate action. I came across a statistic that sort of overall funding for mitigation and adaptation has actually dropped the last couple of years. How do you see that playing out over the next 12 months in an African context, if you're going after renewable energy projects, climate financing, climate-friendly projects, more of a challenge? Are we looking at a slowdown? And this would be something to get your take on as well, Samet, but also you, Dami. But Telef, your thoughts first.
If I may, just a quick comment on your first question, because we often talk about Africa, and Africa is Africa. As we all know, it's a continent, and then we use average numbers. But sometimes we forget that, there are parts of Africa, and particularly African cities, that are booming, growing incredibly fast. Take Nigeria, as you know well. Lagos, 18 million people, huge middle class, growing fast. Northern, western part of Nigeria, no growth whatsoever, probably negative growth. And then if you use average numbers, you look at Nigeria, hopeless. But Lagos in itself is much bigger than, Norway and Sweden combined, and there's a big middle class. So there are huge opportunities, Eastern Africa too. So it's important to bear that in mind. And also many of our companies, during COVID, many of them took, a big took on expected losses on the balance sheets and reserves, and much of it's been reserved during 21. And also, many African entrepreneurs are much better at crisis management than we are in Europe, because they've been running through so many crises. So they're much more resilient, and they're much more flexible than we are, particularly here in Norway, where every morning we listen to the news, it's all about crisis, and then what kind of crisis do we talk about? But to your question, sorry. For renewables as such, there are some positives and negatives. The negatives being the interest rates, and still many countries in Africa failing to come up with legislation or auction processes and other processes that are, what international investors of size need. Positives being high oil price, that's good for renewables. And also last year during COVID, we saw that the prices of solar panels and wind turbines and the likes came up because of logistics, higher raw material prices. What I'm hearing nowadays is it's down again to almost pre-COVID levels for solar panels. I know Ted say, but others that in the industry, that's what I'm hearing now. So that's a good thing too. And the needs obviously are growing, and the awareness and the political will you see among many African countries. So I'm moderately optimistic. But Europe and the US, there's a massive pull for renewables. That will also, mean that a huge demand will come from Europe and from the US these days. So this is a mixed, but I'm moderately optimistic on the renewable side. Adaptation and resilience is tougher to have a clear view because it's so multifaceted in terms of what you can invest within agri, within other sectors. There's a growing awareness, but it's tougher to read the trends in that market, to be honest. Maybe you have a better take than I have on that, but I think it's difficult.
Before I hand over to you, Sami, any questions, comments? Show of hands. Okay, one. Anyone else? There must be more people in here who want to ask a question about what's happening in Africa over the next 12 months. That's two. I just want to get a sense. Three. Okay, so we'll get a couple more responses, and then we'll get to some of those in. I'll give the rest of you a bit more time to think of something to say. There's at least 2 or 3 more people in here with a question. You see, there's one already. Okay, Sami, over to you to pick up on what Telef was saying.
So I think what Telef said makes a lot of sense. Africa is 54 countries. It's not Africa. So you cannot say, growth is, damp here or inflation is high. You need to, again, I'm not an economist, so I like to analyze the actual opportunities. So you need to look at the country, you need to look at the regulatory framework, you need to look at the resource, but also you have to think about the local economy. Africa has 1.2 billion people. Half of them don't have access to power. So the opportunity is there. Africa's land can be covered, 60% of Africa can be covered by solar panels. Less than 1% is covered by solar panels. So the resource is there, the market is there. Then you need to put, the actual specifics into how do I make this work? Which country, which regulatory framework? Can the government pay for the power purchase agreement? Should we go for industrial power, so supplying to industries or to homes? But I think the opportunity is there. You just need to remove the layers of, what to do and what not to do. I was very positive in my presentation, but the one thing that I expect for 2023 for us is that we will say no to many projects before we say yes. So we need to be very cautiously optimistic, and we need to be much more analytical and much more rigorous, because the number of projects that might and will fail is probably much higher than a few years ago.
Right. What would you put that down to? Like, what are the key elements driving that?
Cost of funding is higher. Governments are under pressure because we are an infrastructure investor. So a lot of our projects are long-term concessions, long-term offtake agreements where the government has to provide usually foreign currency. So cost of capital, inflation, sometimes even there's no need for power because the industry is shrinking in some areas. So you need to be very careful. Regulatory framework can a country change the law and apply it retroactively or not? What's the track record? So you have to look at everything in much more detail and much more rigor. And I'm telling you, we will say no to more projects than we've ever said, but the ones we will do, we will follow and we'll make them happen.
Interesting. So you need to be a bit more vigilant
100%.
with your due diligence, right?
Yep.
Okay. Yes, Dami. Yes, please.
Question that you posed earlier. So I think what is clear around the climate space today is that the governments don't have the fiscal space to actually make the investments that are required, right? So I think the private sector will need to play a key role to try to close that gap. And I think that means that, Tulif, I think you mentioned this earlier, blended finance and sort of solutions that actually seek to, develop private-public solutions will be fundamental. I also think in the climate space specifically, regulation is key. So whether it's things like, stimulating EV adoption, I think that there's actually a bifurcation now between countries like Kenya, which seem to be ahead of the curve on some of this, and others like Nigeria, which are behind the curve. So I think there's also a key regulatory impediment that's required to actually stimulate the investment required from a private sector perspective.
We could go on here, but I do want to get some of these comments in. Where were those hands again? It was who was first? It was a lady. Yes, lady in the third row from the back. And you know the drill. Quick introduction. Try to keep your comment or question brief so we can get as many responses as possible.
Thank you very much. Thank you for some very, very thought-provoking and insightful presentations. My name is Helen Isternes Foyn. I represent the Norwegian Agency for Development Corporation, where I head the section for private sector and new partnerships. Now, we are very interested in how we deploy our funds most strategically and most effectively. So we're having a lot of conversations on blended finance issues, that is, using concessional capital to draw in, crowd in private capital. So in the last few days only, I've been hearing a variety of takes on whether there is need for concessional capital or not within the renewable space in Africa. So there are viewpoints that there's already too much subsidization going on. They're seeing crowding out of private capital because too much concessional capital is coming in. On the other hand, there is the argument that there's, and in terms of the African continent, broadly speaking, the subsidization levels for renewables are so low compared to the rest of the world, and there is hardly any risk at all about over-subsidization. So I'd love to hear the private sector actors' view on this. And just to sneak in a second question as well. Very quick.
Very quick question.
Very quick. Any advice on how we as donors work most effectively with the concessional capital to draw in private capital into this space? Thank you.
A short question, but it's not a simple one, that one. Yeah, the second question. Okay, if you can remember those, we'll take a couple more comments and questions and then get some general reactions. Well, a couple hands here. Hitesh, yeah, we'll get 2, 3 more. Yeah, you're on.
So my name is Hitesh. I represent EPC company called Kalpataru Power, and here in Nordics we are called Linne Montage. My question is largely on to all the private investors or the private sector investors. Well, we have been hearing about African governments looking at attracting more and more private investors for many, many, many years. Now it is, as the debt levels are so high, now there is this imperative that private investment has to go up. Now, what, number one, you see as the challenges in the countries, because the government says something and they act something else. So, you know, that's number one problem. Second, do you think that there can be a concentrated effort to influence the government that, look, we have to follow a better structure to attract private capital? Because perhaps the governments also are struggling to get that help. So do you think there is something like that happening, or you think it's required?
Thank you very much. And one more. We'll go to the gentleman in the back row, and then we'll come back for another round. I see the 2 or 3 more hands up.
Thank you, everybody. Thank you for the great presentations you shared with us today. My name is Mohammed El Wakil. I'm working for an international engineering company called DAR Group. We've been working in Africa since 1968. We have 22 offices. My question to Emmanuel, actually, because he mentioned during his presentation that the governments need to find an alternative for funding because of the debt problem. So I would like to hear from you exactly what kind of alternatives would be available for a government to go to. Thank you.
Okay, thank you. Let's take some responses to those points, comments. Sami, you wanted to pick up on one of the earlier points made.
Yes, the first question. So concessional funding is there, but is not big enough, and it's actually reducing. And it's a challenge, especially in renewables, because the returns are very low and the cost of debt has gone very high. So we are working hard to find ways to attract that type of funding. The other question, the second question, which is, what is the route for you and others to deploy the capital? It is very difficult for any institution to deploy capital directly into projects. The biggest opportunity is to partner with people who have the track record, the know-how, and that are present on the ground, like Norfund, like us, like Helios. Because we have the people on the ground, we have the knowledge, we have the track record, and when you invest with us, you automatically get the diversification as well, because you already have a portfolio, you have a pipeline. So I think going on a project-by-project basis, you will need a massive team, you will need to have people on the ground, and you will make a lot of mistakes. So use the mistakes we had and our track record to help you deploy the capital and help us, attract capital and have more impact much faster than if you do it on your own.
Emmanuel, there was a specific question to you around alternative financing for governments. In concrete terms, where else do you go if you can't borrow on capital markets? If you can't attract the investment, you're kind of out of luck, or not?
Yeah, very good question. I think that really is a challenge we are looking at for many countries. And I think in that presentation as well, I was talking about really the multilateral institutions, for instance, really being one source for countries that haven't already been on such programs. So an IMF program, for instance, would help a lot. Of course, it will come with the added benefit of, the anchoring economic transformation required reforms to be implemented. But we've also seen, the likes of bridge financing for some economy syndicated loans. We've seen Kenya do that. We've seen Cote d'Ivoire as well, other commercial funding options. And also and this comes back to the multilateral. So if you take the case of Benin, where more recently they had the African Development Bank really coming in with, kind of a guarantee to help them to be able to raise financing. This back to the multilaterals I was talking about, that help. But that's one side of the equation. The other side is, what can they do on domestic front to generate more revenue? And that's where we really need to look at, the reforms needed to really let revenue mobilization actually materialize. And on that front, we've been lacking for some time. If you look across so many economies, Nigeria in particular, where revenue mobilization is particularly low. If we could drive up that revenue, for instance, if that fuel subsidy reform is implemented and the fiscal impact it can have, then the financing needs of that, or that equation starts to change a bit in terms of how much borrowing they really need to do on the external front.
Difficult to do in 12 months, though.
Absolutely, and that's why reforms take time. Yeah, they do take time. That's why you need to start now.
Yeah, or yesterday, or some years ago in some cases. But yes, look, there are options. I think the key there is the pace at which you can raise financing and the volumes, right? Like, because the reality is, I don't think concessional lending makes up for for private markets, and that's part of the problem. But look, it's a process, not an event, right? But one to watch for 2023. How about this question on governments just doing more to actually catalyze investment? We hear it, we've all heard it many times. Everyone's open for business, everybody wants investment. Until you're ready to make something happen. But the observation that was made there is, with debt levels or debt service levels as high as they are, it's kind of like, well, you don't have a choice anymore now, right? Like you need to figure this out in some way. Might we see more pressure along those lines actually materialize? Or is anyone seeing some of that pressure materializing in governments just kind of accepting that reality of, look, we may not like it, but we got to make some stuff happen. Sama, you're nodding, which I'm hoping means that you've got something to share.
So there is, there's political talk and there is having your back to the wall. So a lot of governments have their backs to the wall. I'll give you an example, because I was privy to see the IMF agreement with the government of Egypt, where explicitly they said that the government in the next 3 years, and it's not a 12-month thing, the government in the next 3 years has to get out of 75 sectors and to partially get out of 49 sectors. And if they don't do that, they won't sign. So I think now is the right time, because the governments don't have a lot of choice, because as Emmanuel said, there are not a lot of options. They're running out of options.
Dami, you first, and then Tony.
I think, maybe there's also a sectoral lens. In some sectors, the government is absolutely fundamental, and I think infrastructure is an obvious one. But you also see in Africa, what you see in Africa is that, driven by technology and business model innovation, there's still scope to do a lot in spite of the shortcomings, right? So I think it's a parallel path. There are certain areas like the social sectors, like healthcare, education, core infrastructure, where the government, I think, has a more fundamental role to play. But I think from an investment standpoint, there's also room to actually look past that and, through tech-enabled solutions and innovation, build, businesses that, can thrive despite the shortcomings. I think that's been the reality that we've had to kind of navigate investing on the continent.
Quickly on this last bit, when traveling in Africa, I often meet with politicians and ministers, and one has to be careful coming from Norway telling what to do. But one thing is, at least on the energy and renewables and the infrastructure side, is to copy best practices from other African countries. Look at what those that manage to make things happen. I mean, within energy, could be South Africa, some northern African countries, Tunisia, Morocco, in infrastructure, basically allowing for PPPs, allowing for private-public partnerships. So it's all about looking into those that actually do it well.
Thank you. We're running short on time, but I want to get some more perspectives in. Yes, right at the back, and do try and keep them brief. There was a hand at the front as well, and I think one more person over here. So we'll take 3 more.
Thank you. Thank you very much. First of all, I'd like to say to NABA and all the partners here how important it is that you organize these kind of events. Many of us here, probably all of us, spend most of our time focusing on Africa, and it's extremely important also when we are in Norway to be able to exchange lessons and discuss challenges. I subscribe very much to what has been said by everyone, especially from Tellef Tollefson on the challenge for renewables. I am founder, head of Empower Energy, which is an investment company in CNI in Africa. We are doing investments, but we are also meeting all the challenges that have been described there, but also opportunities. What I like to focus on is the fact that if you look at solar, we can do the same thing for wind. To elaborate a bit more, the share of solar investments in Africa, the Africa share has been dropping year by year the last 3 years, and is now less than 0.5% of the total. Less than 1 gigawatt of solar was installed in Africa last year. 1 gigawatt. Europe, EU was 50 times more than the whole of Africa. And this is including North Africa. Europe, 50 times more than the whole of Africa in solar installations. This is dramatic, and I don't think we really understand what this means. But there is an opportunity to do something about it, and I think what has been addressed here, of course, the governments are in a bad position and not able to back a guarantee, so we will see a utility scale project being delayed but gradually coming on stream. But if you think about the CNI sector, you have to ask yourself, what is actually blocking investments? And other countries, other continents, you have of course have either a tax credit, you will have a net metering fee, or you will have a fee that your feed-in fee or other things. So Africa is the only country where you don't have an incentive. So what about carbon markets? There is no initiatives in Africa. African Union, Egypt, other countries have started discussing Africa carbon markets. If renewables in Africa were able to attract a carbon revenue like you have in other parts of the world, I'm sure that could change the picture. So my question to Tellef particularly is it possible to think that the Norwegian Climate Fund could join those forces who actually are trying to create an African carbon market, so that all these millions of distributed renewable projects could get access to the carbon finance which is available worldwide, but are currently not available to renewables in Africa? I think that could be a game changer, and it'd be interesting to hear if Norfund think that this is something also the Norwegian Climate Fund could look into. Thank you.
In 2023, of course, right?
For now, I'd just say, yes, that's something we can look into. We haven't done it so far, to my knowledge, but it's also something we need to discuss with the owner. But yes, we can look into it.
So interestingly, actually, just last week, I was looking at a business that was trying to do exactly that, which is sort of effectively use revenues from carbon markets to subsidize, energy costs for local consumers. So there are business models that are evolving that are trying to do that. I think the challenge is to invest in a business where, given all the uncertainty around carbon markets, the sole revenue driver is that, or you're disproportionately skewed to that. But I think there's probably, a way in time to actually optimize around that and somehow, create a model where, as you say, you can effectively use those carbon, revenues to subsidize and widen access on the ground.
Thank you. There are a couple more questions or comments.
My name is Non Kubela Maya Tula. My question is easier. The first one is easier. I think it's for you, Tellef. Norfund has made a huge contribution or hedge towards President Cyril Ramaphosa's initiative to raise 1.3 trillion rands in South Africa. I think you have about 5 billion hedged towards that. Question is, it is difficult to invest directly into projects. We all agree. You do find partnerships, you invest with them, and you hope that they will succeed. How do you make sure that your investment is sustainable, given the other external factors that most people don't have control over, like your regulatory environments and so on and so forth? The second one is, you spoke to just energy transition without calling it that, which I like very much, meaning that the pace and all of that has to be taken into consideration, the local people and what happens to them. The last question is sort of a comment and a question, and I think it's also related to Mr. Same's point. I'm equally embarrassed that 40% of the metals that go towards battery production is in Africa. We know the reasons why not. To that point, I am thinking, I know you're looking at 2023, I get that. But in terms of planning, contributing.
You read my mind. I was going to comment on it again.
Yeah. Yes, thank you very much. How far do we look forward to be preemptive and proactive, to also manage the impact of the investments we seek to make? Today, or a few days ago, Norway announced that they have quantified the seabed mineral potential in Norway, and we know we're going in that direction. Thank you.
Thank you. Okay, that's 3 questions. I remember at least 2. Let's take one more contribution, and then I will just throw all of that information at you guys and see who wants to pick it up. Yeah, we haven't been on this side of the room, all the way to the left. Sorry to make you run across the room. Trying to be somewhat democratic here. And Same, I'll give you until mid-2024 on that last one. So it's not just 2023, all right? You got 6 extra months.
Thank you for the opportunity. You really opened my eyes and gave me some information to think about. Carl Jacob, roadmap advisor for a hybrid stealth mode venture capital firm. A bit of a different take. I know the opportunities are going to be quite drastic, but keeping it simple, how will these opportunities be involved in with the youth, etc.? Because they need to be involved. How are they going to be involved in these wealth creation opportunities?
All right, thank you. So we have some questions about South Africa and a couple other questions. Who would like to go? Tell us.
If you start off with South Africa, I mean, on the renewable side, we part of projects in total 5.4 gigawatt, and it's being told that you need at least 9 gigawatts to reduce load shedding down to the minimum. So that in itself, we believe, is very important. But in terms of sustainability, what we've mainly been doing is to help funding Black economic empowerment entities to keep their share of the investments, and thereby, in a way, helping out in that regard. But it's a constant trade-off also as regards just transition, that we sometimes fund entities that are rich, or we team up with rich people in order to make projects happen, and thereby not helping to reduce inequalities. But then we try to combine it also with microfinance, with various initiatives that are targeting the poorest of the poor, or at least SMEs. But we cannot point to every single investment being in that regard. Just as a quick, because some investments people will point and say, you're not helping out as regards inequality whatsoever. So it's a trade-off. And also when it comes to youth, it's very hard to invest in companies that solely target the youth. But we believe in the trickling down effect. By helping job creation in general, it will ultimately also benefit and help the youth. But it's very hard to have youth-specific entities to invest into, quickly from my side.
Dami, you mentioned demographics. Presumably hearing the word young is not a foreign concept to what you guys do.
Yeah, no, absolutely. And I think you can think about it from different perspectives. One, on the demand side, clearly that's a huge addressable market, right? And that factors into how we think about the opportunities to invest. But more fundamentally, I would say that it also ties to the security point, that employment is just a key, and you have just huge levels of unemployed youth in many of these economies today. So I think actually tackling the security point is inherently linked to also solving the youth issue. And I would say that when you look at what's happened with the emergence of technology on the continent and businesses that have spun out, that's a very young, I guess, demographic that's actually building those, businesses. So I think certainly in the tech space, we're seeing youth engaging and doing really interesting things. But I would say on the social front, frankly, they're huge sort of failures that need to be addressed, and it's fundamental. And I think it's education, it's sort of, like I alluded to, ultimately linked to long-term stability and security as well. But there's no doubt that both from a sort of supply standpoint and a demand from a consumption standpoint, it's a huge demographic that you have to address in Africa.
Maybe just to add to that broadly on the macro front as well. I think, if you're looking at the fact that the renewables probably result in more affordable energy being available. And here I'll take an instance of Senegal, where just last year alone, they spent about 4% of GDP equivalent of fiscal revenues just to subsidize energy, because a lot of the imports is heavy fuel oil. And I saw a picture of you showing Senegal's president on a solar field. If we could get more of these measures there, where you start to create that fiscal space that governments need to be able to invest in the youth, to be able to invest in supporting skills for the future, then you're going to get that youth growth, youth employment growth that you want. So it's the perspective to also look at it that would also help out.
Now, the clock says we're out of time, but I do want to hear from Same about that question. How do we get that those 40% of metals to be turned into batteries in Africa by the middle of 2024.
I told you antidepressants are the solution. So I want to first talk about the youth. I think that the one sector, and Helios have done a great job in terms of raising money in that. The one sector where the youth have a very good opportunity is technology, and this is where they're thriving. So you don't need to wait for governments to open a space for the youth to do something. They're running on their own on the technology side, and this is an area that a lot of people are focusing on. Going back to the point on planning. So I'll tell you what we are doing. We're now in the phase of studying where do we put the first, the refining. So first step from the mine is to refine. But the problem is that in a battery, you have many metals. You have nickel, cobalt, copper, lithium, etc. So we have commissioned a study to see where do we put the refining capacity. Should we put it next to the mines? Should we have small refineries close to each of the minerals or the metals? Should we have the refining capacity close to the power because it's very power consuming, or should we have it close to the port? So from the outside, it looks like it's an obvious solution and we have to do it. But when you dig deeper, it's very, very complicated. And that's exactly why we have to plan, we have to do it, right? And we're commissioning studies. Today, I'm also, actually, Norfund is very kindly introducing me to someone who's interested to invest in battery, in the final parts of the battery. So we're talking to car manufacturers at the far end, we're talking to miners at the beginning, and then we bring everything together and hopefully start developing that value chain.
I have to say, if African economies don't end up being at the forefront of the rare earths boom, the metals boom, the digital economy boom, that will be very, very disappointing and frustrating because it, as you've said, as many people have said, it simply makes no sense. And more than ever, there's hopefully the impetus to do something about that. So look, it's a process, not an event. We joke about what happens in the next 12 months, but this is huge and a generational opportunity for Africa, which I'm sure AFC doesn't need any reminding of. Okay, we are officially out of time. There's obviously plenty more that we could do. We have a bit of networking left, a bit of housekeeping left for you in a minute. There's some gifts coming. So it wasn't for nothing here this morning. You're going to be rewarded the moment you've all been waiting for. Before I let the speakers go, first of all, thank you. And finally, I'm going to put you all on the spot real quick. Okay, hypothetical. You're at an airport and someone's running to catch their plane. They've never been to Africa. They're a Western investor. I'm visiting Africa the first time in 2023. What's your advice? And you have 5 seconds to give them some advice, and you can't think about it any more than that. 5 seconds. You got to imagine you're in that moment. What's your advice? One thing for 2023.
Do it.
Do it. I like it. You can't say the same thing. Just do it.
Just do it.
Sorry, Telef.
Just don't go to Cape Town or African beginners.
And Sami, you're not going to escape.
As a tourist, my honeymoon was in Africa. I took my kids to Africa, but I've spent the last 27 years, all of my career in Africa, so I can't.
He only caught half of that. The door's closed, unfortunately. But I think he got the essence, which is it's a good place to be. Yes. Ambassador, you were going to...
I'm sorry, I just can't help not asking this question or make this comment, because every time we are invited to an African meeting, it's all about sub-Saharan Africa. I see that it's all the time about sub-Saharan Africa. Mathilde knows it. We have been as North African ambassadors made this comment as well. But I would like, all the investors present in this room, as well as the institutions and organizations, be aware of the fact that geography is there to remind all of us that we are all Africans. And it's not only about sub-Saharan Africa. It's very important for us and for Africa, for the future of Africa. Thank you.
A very heartfelt thank you to the ambassador of Morocco, in case you were wondering. A point well taken and well made. Yes, of course. It's a relic to somehow think of North Africa as different. It's kind of strange. I believe the IMF still qualifies North Africa as part of Middle East and Middle East, in Europe, Middle East, and North Africa, or something like that, which is weird. That's something we certainly agree with at NABA. And unfortunately, we didn't spend much about talking about North Africa, but I'm sure there's plenty to be said. And if you have a chat with them during the break, I'm sure they will confirm that. At this point, thank me in thanking the speakers. We're going to have some networking. And that's coming up. That's coming up. For now, you're free to go. Have a seat. And then we've got one final piece of housekeeping. Thank you so much to all of you. So, this is kind of important. Show of hands. How many people in here have heard of the NABA Summit? Yeah? Keep them up. Keep them up. How many have been before? Keep them up. Okay, now put your hand down if you're not going to come again this year. Okay. Anyway, 5th of September 2023, the Grand Hotel here in Oslo. The theme is a world in flux. A fitting theme, I think, for the times we are in. The website is live now. You can book your ticket now. Just do it. We haven't decided yet. Yeah, we haven't decided yet whether we're going to let you leave without a ticket, but we'll cross that bridge when we get to it. But please do sign up now. There's no point in waiting. You know it's a great show, and it's going to be no different this year. On that note, I'm going to conclude proceedings for the Outlook. Hope we've stimulated some thought. We'll have a bit of networking, follow up on some of these things. Thanks so much to the partners. Thank you so much to NHO for hosting us, the speakers. And thanks to all of you for coming.